2026 tax changes, how charitable donations will be affected. A sweeping change to U.S. tax law could inadvertently choke off billions in funding for the charities we rely on. And it all hinges on a fundamental shift in who gets rewarded for their generosity. Under a significant tax overhaul passed during the Trump administration, the landscape of charitable giving is being redrawn. While the law is often remembered for making the increased standard deduction a permanent fixture, a less discussed component is set to dramatically alter how donations are treated by the IRS, creating both new opportunities for everyday givers and new hurdles for major philanthropists. Let's break down what this means. For years, the primary tax benefit for donating to charity was reserved for those who itemized their deductions, a group that typically represents the top third of American taxpayers. However, the new law introduces a universal charitable deduction designed to incentivize giving across all income levels. Starting in 2026, this new provision will allow individual taxpayers who take the standard deduction to still write off up to $1,000 in cash donations. For married couples filing a joint return, that amount doubles to $2,000. This is a welcome change for millions of Americans who give what they can but previously received no tax recognition for it. But here's where it gets controversial. To fund this broad new benefit, the rules are tightening for high-income donors, the very people who often provide the foundational support for major institutions. First, for taxpayers who do itemize, there's a new floor. The first 0.5%, 0.5% of their income donated to charity is no longer deductible. For example, someone with an adjusted gross income of $1 million would see the first $5,000 of their donations receive no tax benefit. And this is the part most people miss. This directly reduces the incentive for the initial act of giving. Furthermore, for Americans in the highest tax bracket, the maximum deduction they can claim for their contributions will be capped at 35%, a reduction from the previous 37%, while a 2% diff. Tax breaks for charitable contributions, what 150 million Americans need to know. Imagine this, a whopping 150 million Americans might soon see a little extra cash in their pockets thanks to a new tax break on charitable donations. But here's where it gets controversial. This isn't just about saving money. It's about changing the game for how Americans give to charity. Let's dive in and explore the nitty-gritty of this major policy shift and why it might just spark some heated debates. We research all brands listed and may earn a fee from our partners. Research and financial considerations may influence how brands are displayed. Not all brands are included. Learn more. In a dramatic turn of events, President Donald Trump's One Big Beautiful Bill Act is set to make a significant impact on the way Americans approach their taxes and charitable giving. Starting in the 2026 tax year, a new set of rules will allow taxpayers who opt for the standard deduction, roughly 90% of all taxpayers, to also claim a deduction for their charitable donations. For single filers, this means a $1,000 deduction, and for married couples filing jointly, it's $2,000. But why does this matter? Well, every year, Americans have a choice when it comes to filing their individual income taxes. They can either itemize their deductions, which means they lower their taxable income by subtracting specific expenses or losses using a Schedule A form, or they can take the standard deduction, a predetermined amount of money that's shielded from taxes. Previously, those who didn't itemize couldn't benefit financially from their charitable contributions. But Trump's latest tax law is changing that. If you don't itemize, you now have the opportunity to write off your charitable giving. Explains Rob McClelland, a senior fellow at the nonprofit Tax Policy Center. This change is a direct response to the Tax Cuts and Jobs Act, TCJA, which Trump signed during his first term. The TCJA significantly increased the standard deduction, making it more appealing for millions of people to opt for simplicity over itemizing. However, this also meant that many taxpayers lost out on the ability to deduct their charitable donations, which was seen as a major disincentive for giving, and this is the part most people miss. The impact of the TCJA was immediate and significant. A study by Indiana University found that charitable donations declined by a staggering $20 billion in 2018 due to the changes in tax law. The researchers noted that the TCJA substantially reduced the tax incentive for people to give to charity by nearly doubling the standard income tax deduction. There was a brief period during the pandemic where non-itemizers could claim a $300 deduction for cash contributions to charity. Now, with the new rules set to take effect in 2026, upwards of 150 million Americans could be eligible for a modest tax break if they donate to charity. But here's the catch. While this is good news for some, the impact on charities themselves is far from clear. McClelland, who previously worked as a tax analyst for the nonpartisan Congressional Budget Office, points out that the changes won't fix the underlying issue of discouraging charitable giving. The enhanced standard deduction has been made permanent, and while more people will be eligible for a small tax break, the actual dollar amount of charitable donations could fall due to fewer big donors. Overall, I would say things got worse, McClelland says, referring to the new disincentives for large charitable donations. So, who exactly benefits from Trump's charity tax deduction? The main winners, according to McClelland, are taxpayers who typically take the standard deduction and donate smaller amounts of money each year, around $1,000. These donors can simply add the new charitable giving deduction to their existing slate and receive a small tax break. For example, if you write off $1,000 and your tax bracket is 22%, you'd save $220. But for those who itemize their taxes, the new rules actually disincentivize charitable giving further. These taxpayers tend to be wealthy and donate thousands or even millions annually. About two-thirds of taxpayers with incomes over $500,000 itemize their deductions, according to the Tax Policy Center. Beginning next tax year, a different provision sets a threshold for itemized charitable contributions, equating to 0.5% of a taxpayer's adjusted gross income. For instance, an itemizer earning $500,000 would need to exclude the first $2,500 of their donations before receiving any tax benefit. Some of their contributions that used to be deductible will now no longer be deductible, McClelland notes, adding that the changes basically amount to a tax increase for this group. Separate research from Indiana University found that this change alone could reduce charitable giving by as much as $8.2 billion annually. This double disincentive is why McClelland is worried about charitable donations falling overall. The new rules impact those who tend to give the most. The accounting firm GHJ Advisors, which specializes in the nonprofit sector, said these two provisions in particular pose significant challenges for the industry, but notes that the extension of tax breaks to most Americans has the potential to democratize charitable giving. Then, there are the people in between, who aren't sure whether they're itemizing yet. They have some tough choices ahead. Those on the fence will want to consider separate provisions of the new tax package that increase other itemized deductions they can claim for state and local taxes known as SALT deductions, which have been raised from $10,000 to $40,000. McClelland says the new 0.5% donation threshold, the reduced tax benefit for top income earners, and the increased SALT deductions all change the calculus. We're snowballing, he says. It can get really complicated really quickly. The silver lining, at least, is that the charitable donation changes won't go into effect until the next tax year, impacting the taxes you'll file in spring 2027. So folks have some time to consult a financial planner for the best course of action. So, what do you think? Will this new tax break encourage more charitable giving, or will it just complicate things further? Share your thoughts in the comments below, and let's get the conversation started. DC Download: Navigating Congressional Priorities and the Charitable Sector. In the realm of philanthropy, much like a bustling ice cream parlor, The charitable sector serves up a myriad of flavors to address society's needs. From ensuring food security and stable housing to fostering education and disaster relief. As Congress navigates a tumultuous sea of legislative priorities this summer, our sector is steadfast in its commitment to keep the needs of communities front and center. Nonprofits are deeply engaged in a spectrum of issues, reflecting the rich diversity of our missions, from tax policies and federal funding to workforce development and healthcare access. We're advocating for a comprehensive approach that acknowledges the breadth of our work. As lawmakers deliberate on their legislative menu, we're making our presence felt, underscoring the vital role of the charitable sector and the need for robust support. The recent passage of the Republicans' ambitious tax and spending legislation, humorously dubbed the One Big Beautiful Bill Act OBBBA on July 4, 2025, has stirred up a whirlwind of emotions. Amidst sweeping policy changes, the charitable sector emerged victorious in securing a crucial safeguard for individual donors, one that not only promotes new contributions but also bolsters the sector's operational strength and financial stability. The expanded non-itemizer deduction, championed by the Charitable Giving Coalition, United Philanthropy Forum, the Association of Fundraising Professionals, and Independent Sector, allows individual taxpayers to deduct up to $1,000 for single filers and $2,000 for joint filers, even if they choose not to itemize their returns. This pivotal move towards inclusive charitable giving opens the door for a wider audience to contribute to community investment, reinforcing the power of collective action. Yet amidst this triumph, the legislation conceals a series of detrimental provisions that jeopardize the sector's long-term viability. The bill imposes a 0.5% income threshold for itemizers seeking a charitable deduction, potentially leading to sporadic, large donations instead of consistent annual contributions. Additionally, it caps the value of itemized deductions for high-income taxpayers at 35%, projecting a $41 to $61 billion decline in philanthropic giving over the next decade. More alarmingly, it enforces a 1% floor on corporate charitable giving, mandating that corporations donate at least 1% of their taxable income before qualifying for any deduction. These measures erect barriers to giving, restrict access to vital services, and cast a shadow of uncertainty over the nonprofit sector's ability to meet escalating community needs. Independent sector vehemently opposed the bill's passage and remains dedicated to reversing these harmful provisions. As the dust settles on the reconciliation package, Capitol Hill lawmakers turn their focus to another pressing matter: funding the federal government for fiscal year 2026. With a September 30th deadline looming, Congress must either pass all 12 annual appropriations bills or enact a continuing resolution, CR, to avert a government shutdown. Currently, only 2 of these bills have cleared the House, leaving 10 still in the legislative pipeline. Even after House approval, each bill faces the gauntlet of the Senate, where the process may differ significantly. Historically, these bills may be consolidated into a larger omnibus package. However, with the House departing for an early summer recess and the Senate grappling with cabinet nominations, timely completion of appropriations work seems unlikely. A CR extending current funding levels into the fall appears imminent. Yet, with Republican leadership facing internal divisions and strained relations with Democrats following the contentious passage of a partisan rescissions package, even a short-term funding bill may encounter roadblocks, heightening the specter of a government shutdown. While rare under unified party control, shutdowns under divided government are not unheard of. And the coming weeks will reveal whether lawmakers can avert this scenario. In another heated legal battle, 2 churches are challenging the Johnson Amendment, aiming to blur the line between political involvement and the traditionally nonpartisan stance of nonprofits and charitable organizations. The Johnson Amendment, established by then-Senator Lyndon Baines Johnson, delineates a clear boundary for 501c3 organizations, prohibiting them from engaging in political campaigns or endorsing candidates. Its intent has always been to ensure that nonprofit activities remain focused on the public good rather than advancing political figures or ideologies. Currently under review by the United States District Court for the Eastern District of Texas. The lawsuit contends that the Johnson Amendment's nonpartisan provisions infringe upon the First and Fifth Amendments of the U.S. Constitution. The plaintiffs argue that the restrictions unjustly hinder their ability to speak on partisan political matters, citing perceived inconsistencies in IRS enforcement. Should the plaintiffs prevail, it could embolden other religious entities to push back against IRS enforcement, potentially weakening the amendment's application. Success in this challenge could fundamentally alter the landscape of nonprofit governance, permitting religious organizations with 501c3 status to actively participate in political activities. Recent polling by Independent Sector reveals overwhelming bipartisan support for maintaining the separation of politics and charity work. 75% of voters, including 69% of frequent churchgoers, believe that charitable organizations should remain barred from endorsing or opposing political candidates. This lawsuit stokes broader concerns. If the Johnson Amendment is diluted or overturned, it risks eroding trust within communities and may allow tax-exempt funds to sway political outcomes, sparking fears among community members that their donations could be misused to support candidates they don't endorse. The lawsuit not only jeopardizes the foundation of the Johnson Amendment, but also threatens the integrity of all 501c3 organizations. If these entities are permitted to align with political officials and agendas, it could compromise their effectiveness and authenticity in serving communities, particularly when political positions may not align with the needs or values of the people they aim to assist. In a positive development, a bipartisan coalition of lawmakers has introduced the Small Nonprofit Retirement Security Act, S. 2365, H.R. 4548, designed to level the playing field for small nonprofit organizations offering retirement plans. Sponsored by Senators James Lankford, R. Oklahoma, and Catherine Cortez Masto, D. and V. in the Senate, and Representatives Vern Buchanan, R. Florida, Jimmy Panetta, DCA, Blake Moore, RUT, and Brad Schneider, D. Illinois, in the House. The bill seeks to rectify an existing inequity by allowing nonprofits to claim Secure Act startup tax credits against their payroll tax liability. This reform would facilitate retirement plan offerings by nonprofits, which employ approximately 10% of the U.S. workforce, granting them up to $5,000 per year in startup tax credits and an extra $500 annually for automatic enrollment. Independent Sector has been actively lobbying for the bill's passage to ensure nonprofits have equal access to retirement benefits as for-profit counterparts. The Department of Education's proposed changes to the Public Service Loan Forgiveness (PSLF) program have raised red flags among nonprofit advocates. Created by Congress in 2007, PSLF ensures that student loan borrowers working in public service, including at 501c3 nonprofits, can obtain student debt relief after a decade of qualifying payments. However, the department is considering a rule alteration that would permit it to disqualify certain nonprofits from PSLF eligibility based on the nature of their work, particularly those deemed to engage in substantial illegal activity. This ambiguous criterion opens the door to potential political targeting of organizations. If implemented, payments made while employed by a disqualified entity would no longer count towards PSLF, causing distress for current borrowers. Independent Sector stands firm in its support for PSLF's integrity and opposes any attempt to exclude nonprofits based on their mission or the communities they serve. Existing laws already provide mechanisms to address legal violations by nonprofits. The IRS can revoke their 501c3 status, automatically removing their PSLF eligibility. establishing a parallel process where the Department of Education can selectively disqualify organizations, invites politically motivated decisions that undermine the law and borrowers' confidence in the program. Uncertainty looms over whether the rule would apply retroactively, potentially devastating borrowers who made payments in good faith, assuming their service would be recognized. Upon the formal release of the proposal, a public comment period will ensue. Independent sector will closely monitor the situation and notify stakeholders of opportunities to submit individual comments or join a collective letter of opposition. Our commitment to defending PSLF and the nonprofit workers who depend on it remains unwavering. In a troubling turn of events, recent congressional hearings have placed nonprofit organizations under intense scrutiny, using inflammatory rhetoric to target specific groups. The House Judiciary Subcommittee on Oversight convened a hearing titled "How Leftist Nonprofit Networks Exploit Federal Tax Dollars to Advance a Radical Agenda," followed by the Homeland Security Committee's "An Inside Job: How NGOs Facilitated the Biden Border Crisis." While these hearings reflect a disturbing trend of politicizing the nonprofit sector, committee Democrats have reaffirmed their stance that, despite ideological differences, they staunchly support the right of nonprofits to exist and operate free from political retaliation. With similar hearings anticipated in the coming months, we will diligently track developments. Don't miss the opportunity to register for Independent Sector's National Summit 2025, taking place in Atlanta from October 27th through 29th. As our sector confronts urgent challenges and long-term needs, this event offers a unique platform to unite leaders and professionals from across the charitable sector, align on solutions, amplify our collective voice, and catalyze enduring change. Join us in shaping the future of the charitable sector. We eagerly anticipate your participation.